Sapphire Foods had a decent listing on bourses last week considering the weak market sentiment. The stock opened 11% above the issue price. It went 17% above its issue price, but weak market conditions saw it close just 3% above the issue price. The quick service restaurant industry has recovered strongly in Q2 FY22, and it is expected to see strong growth given the unlocking measures and the fall in COVID-19 cases. Aggressive store expansion plan and the expected shift from the unorganized segment will further fuel growth. SFL, with two globally recognized brands, KFC and Pizza Hut, and a store count of 460 stores, has a huge runway for growth. It is adopting best practices such as lower store size, flexible working hours for employees, and pace-setting initiatives to improve profitability. With the increase in scale expected to reach to the store count of 680, SFL's margins are expected to improve by about 450 basis points, and it will narrow down the margin differential with the bigger players. The company is poised to deliver a healthy EBITDA growth, and we expect the company to turn profitable in FY23. SFL is the franchisee of Yum brands in India, having about 35% of Yum's total store network as of September 2021. SFL has the rights to open KFC stores in 10 states and Pizza Hut stores in 11 states. Apart from India, SFL has the rights to open Pizza Hut stores in Sri Lanka and Maldives and Taco Bell in the Sri Lankan market. Post the unlocking following the fall in COVID-19 cases and increased vaccination, QSR players are seeing a strong demand recovery. Jubilant Foodworks has seen revenue cross pre-COVID levels. Even players focused on dine-in, such as Burger King, saw average daily sales touching pre-COVID levels in October 2021. The opening of colleges, cinemas, and malls will drive the growth momentum for QSR players such as SFL. SFL store expansion in the last fiscal was affected by COVID-related restrictions, with the company opening only 4. However, with COVID-19 restrictions easing, SFL has accelerated store expansion. It has opened 46 new stores in H2 FY22 with 32 in Q2 FY22. We expect the company to open about 110 stores in FY22, which would drive growth. SFL has been focusing on smaller stores in the past 2 years. The average store size for KFC has reduced from 2,700 square feet to 2,000 square feet, while for Pizza Hut it has reduced from 2,400 square feet to 1,400 square feet. All future expansion will be in smaller store formats. Smaller stores result in lower rent and other overheads, thereby improving profitability and reducing the break-even time period. Furthermore, with increased store addition and revenue growth, SFL will realize the benefits of scale. Better raw material sourcing as well as spread of fixed costs over a larger revenue base will lead to margin improvement in SFL. SFL is adopting best practices in the industry such as flexible work arrangements, which will result in the optimization of employee costs. Also, SFL has adopted the pace-setter approach, under which a store with best operational practices and profitability is selected and its operating procedures are implemented in other stores. We expect SFL's margins to improve about 470 basis points from FY20 pre-COVID levels. We expect significant gains for branded QSR players in the past COVID-19 era. A lot of smaller food services providers were affected by COVID-19 and they would find it difficult to sustain operations. Moreover, consumers would prefer hygienic and trusted brands in the aftermath of COVID-19, thereby benefiting branded players like KFC and Pizza Hut. Unorganized players have a dominant 2/3 share of the QSR industry, indicating huge scope for gains in the organized segment. Moreover, SFL has indicated it would pursue inorganic opportunities for growth as well. SFL has a larger revenue size compared to Westlife and Burger King India. Also, SFL's gross margins are higher than Westlife Development and Burger King India, which can largely be attributed to the nature of products, that is, chicken offerings and pizza. Given the higher gross margins and better scale of operations, SFL has higher EBITDA margins as compared to Westlife and Burger King. SFL's gross margins are the same as that of Devyani International, a larger franchisee of KFC and Pizza Hut in India. However, Devyani's size of operations compared to SFL's gives it an advantage. Moreover, Devyani acquired the India franchisee rights in 2012, whereas SFL obtained it in 2015. Devyani started to restructure and open smaller size stores ahead of SFL. With the rapid store expansion and focus on smaller format stores, we expect SFL's margins to improve and margin differential with Devyani to narrow. SFL is trading at a discount to Westlife Development and Burger King India on FY23 projected EV/EBITDA multiples despite a better scale and margin profile. Compared with Devyani, SFL's multiples are at a 30% discount. With the improving margin profile of SFL, we expect the discount to Devyani should also narrow going forward. Investors with a long-term view should add SFL to their portfolio.